name is Sam Young. I'm the Managing Director of Plan Giving and Strategic Advisor for Compassion and Choices, and I'm honored to be your host for today's webinar. Today, we have John Keenan as our guest to discuss plan giving and strategic financial planning. John has been in the securities and insurance industry since 1996. John is currently a senior partner at SEIA's Virginia office. His practice focuses on investment management and overall wealth strategies for affluent individuals and owners of government contracting businesses. John's practice is one of DC area's leading 401k retirement teams, proudly helping participants of all income levels to achieve financial independence. For many years, John and his team have been involved on behalf of their clients with many local charities, including Fisher House, Washington Jesuit Academy, DC Central Kitchen, Northern Virginia, Conservative Trust, and Toys for Tots. John grew up in Potomac, Maryland, and lives in Kensington with his wife, 2 sons, and 2 dogs. John received 2 degrees from the University of Maryland, College Park, from the College of Arts and Sciences. I'd like to now turn it over to John Keenan to continue with our presentation and thank him for being here today.
Thanks, Sam. Hi, everybody, and thank you for giving us some of your time today. My name is John Keenan. I also have my associate, April Rosenberry, who is actually new to our firm and building out our estate planning practice. I've been working with Compassion and Choices for the last, say, 5 years. And Sam and I have been talking about this since kind of the pandemic, I think, Sam, but really trying to offer a value add for those of you who are connected to the organization to just try to give you some ideas around estate planning. And so we're calling today's session, ideas for a changing landscape. So what we thought would be helpful for all of you who may, some of you may be coming at this with a very basic understanding of estate tax laws and different charitable tax laws and deductions. And some of you might be looking for some more advanced strategic planning. So I asked April to join me this afternoon to really kind of, give you a lay of the land for some of the basic and estate planning techniques that you can use. But just to give you a backdrop of who we are and where we're coming from, SEIA, Signature Estate and Investment Advisors, is an independent investment advisor firm. We custody clients' accounts at Charles Schwab and Fidelity Institutional. We do manage now about over $20 billion, a lot of that due to the run-up in the market. And I think it makes sense to talk about these types of estate planning ideas for those of you who are either philanthropically inclined. Maybe there's some of you on this call that just don't like paying income taxes, or maybe the thought that the government might take a large portion of your estate, whether it be income or estate taxes, it might bother you. And so there are some, tried true planning techniques that you can use. Giving you some ideas about, our other services that we do provide. And after this call, if anybody is interested in following up with April or myself, just reach out to Sam. Sam knows where to find us, and we're happy to do a complimentary call, just sit down 30 minutes, a half hour or so to talk about, your current estate plan, and April can talk a little bit more about some of the tools we offer there. But I do actively work with a practice of 225 clients. Some are higher net worth, some are nonprofits like Compassion and Choices. So I think we have a pretty good lay of the land of what clients like yourself are challenged with, what you're concerned about, what different types of goals and objectives that you have. But keep in mind, all of these types of ideas that we're going to talk about today are not a one size fits all. You really have to kind of factor in, what are you trying to accomplish with your income needs for yours and possibly a spouse's remainder of your lives. You have to think about what types of goals that you want to accomplish, for your estate tax and or your charitable planning. And as you can kind of talk through some of those concepts, we think it's always a good idea to review what you may have done already, or if you've done no planning, to really think about some of these ideas you're going to learn about today to see if they make sense, given what you're trying to accomplish. So before I get into these, I know everyone's dying to talk about temporary tax law changes, but another reason why I think this estate tax conversation is very important is keep in mind, we have had an incredible 10 to 15-year run in the stock market. We're over 5,000 on the S&P. And ultimately, when it comes to planning, people also get concerned because, then the thought becomes, well, what happens if the stock market goes down? Can I afford, to make these types of gifts to an irrevocable trust, making gifts to a charitable institution? And there are lots of different planning tools that we utilize in the industry that help people financially test that type of modeling to make sure that you can comfortably afford to do these types of things. But keep in mind, when the stock market does run up, lots of clients have immense gains in stocks like Apple and Google. If you're lucky enough to have invested in NVIDIA, it was up over 250% last year. And the good news about that is your net worth has grown. The downside of that is that there are capital gains that could have to be paid. If it's inside of a qualified plan, you might have to, your heirs might owe income taxes. And then ultimately, if your assets are over a certain level of net worth, there may also be federal and/or state inheritance taxes. So with that, I kind of want to dive into just giving everybody a little bit of a refresher for, what changes to the law were passed under the previous administration. And it's important to note in this little footnote here in the middle that these tax laws, a lot of these, especially when we're talking about estate tax, are going to revert back to older, less favorable exemptions on December 31st of 2025. And so if nothing happens, in the current election cycle, we can probably anticipate that the current, Senate and Congress, which doesn't seem to be able to get anything passed, likely that these tax laws are just going to what they call sunset, and we're going to go back to these other provisions. But you also want to keep in mind, depending on how the election turns out, the Democrats might actually get more aggressive with the exemptions. They actually proposed a rule last year to reduce the current exemption from about $13 million down per person down to $3 million. That got shot down. But that's important to understand that it's at least putting a flag, in the sand of where the Democrats feel like they might want to have the exemptions land. And then I'll talk a little bit about that. So, don't necessarily go out and kind of take hasty action on just some of this information, but keep in mind there is a clock ticking, especially when it comes to the estate tax, which is what we're going to focus on a little bit later. So for those of you that are still working, on the left-hand side of this slide, this was the old law that will likely come back into effect on January 1st of 2026, which is really not that far down the road. So the temporary income tax law did go down about 2 to 4%, depending on which bracket you're in. So that's good. There was some income tax relief in there for those of us who have ordinary income. On the SALT taxes, I would say this is another big one. The other two are not as important, but the state and local taxes, this is a real big one for our clients, especially if you live on the East Coast, or I know April's on the West Coast. I mean, anybody that's got an appreciated value of property that you're paying significant, property taxes on, in addition to the fact you might be paying significant state income taxes on, you used to be able to deduct a large portion, if not all, of those taxes against your federal taxes. And that was a big deal, right? Especially, like I said, if you've got high property tax and high state income tax. The temporary law that is still on the books limits your deduction to $10,000 per taxpayer. So if you're married filing jointly, you can only deduct $10,000 of your property tax or your state income tax. So if you had $30,000 or $40,000 of combined tax, you're only able to deduct $10,000 of that against your federal tax exemption. So that's a big one. I think, again, for a lot of people, that would actually bring back some different tax relief for you. A lot of our clients are over the age of 55. And one thing, when clients retire, one of their bigger expenses that, hopefully no one ever has to use, but, medical expenses that you pay out of pocket that either your Medicare Part A or Part B don't cover, or if you still have medical insurance from an employer, there are always expenses. Fidelity did a survey, for example, years ago, that they estimated that the average individual citizen in the US over the age of 65 on average, will spend over $150,000 out of their own pocket on their own medical expenses. And, when I first got into this industry, we did a lot of long-term healthcare planning. And, for people that, God forbid, if they, have Alzheimer's or some other situation that is not necessarily acute, you can spend, 3, 4, 5 years either in home healthcare living, assisted living, or nursing living. And some of those costs can be significantly more than $150,000. So back to the tax law, though, the old law allowed you to deduct anything over 7.5%, and the current law, you had to get over 10% of the threshold. So you actually are able to deduct a little bit less than what you used to. But the good news is, if you did have significant medical expenses, there are some really cool techniques. I'll throw one out there. If anyone's family member, a loved one, or a parent is potentially going through this, you can pull money out of your IRA effectively tax-free and pay for the person's care out of their IRA, because you're able to get these offsetting medical deductions. That's a really big expense. Some people we know might move into a graduated care facility in the DC area. They're called continuing care retirement communities, where you might go to independent living, assisted living, and hopefully never, but they have nursing care available there as well. And when you move into one of those places, it's kind of like a real estate transaction. A lot of the down payment on those places is a legitimate medical deductible expense. And so a lot of times we'll encourage our clients, and people don't think this way. They usually, when they do real estate, they want to pay with cash, but they're actually better off taking the money out of their IRA because they're going to get a good portion of that's going to be deductible. So enough on the medical expenses. Mortgage interest, this may not be as applicable to everybody on the call, but if you have kids or grandkids who are buying their first home, the deductible interest went down. It used to be you could have as many properties as you wanted up to $1 million. You could deduct the interest cost on that. Now it's only up to $750,000 for any property acquired after 12/15 of 2017. And keep in mind, all of us have been paying attention to interest rates, as it relates to the stock market. But mortgage rates at one point this year had topped out at like 8%, right? And so not being able to deduct a portion of that 8% interest, that's a big deal, right? For affordability for home buyers. So that might also be, again, the pendulum swinging back the other way. If that were to go back to $1 million, that might help a lot of people, because the value of everybody's properties on this call have likely also gone up significantly since the pandemic. So lastly, and this is really kind of the meat and potatoes of our presentation when it comes to estate planning, the unified credit is something, and April might spend a little more time just kind of walking you through this, but to give you kind of the numbers of it, when each citizen in the United States passes away, you are exempt at the federal level. So everybody's state, and I know there's a lot of people from different states on this call, so you have to check your local states, in terms of what your inheritance exemptions are in that state. For example, right now I'm doing this presentation in our office in Virginia. The state of Virginia does not have an inheritance tax. So when you pass away, you can leave as much money as you want to your heirs, and there's no state inheritance tax. However, there is a federal tax, and the old law used to tax any estate over $5.5 million on an individual person. But if you're married, you're allowed to unify those credits under certain planning. You have to use certain planning trust, which April is going to talk about. But you could unify those two credits together to put the $5.5 million and exempt $11 million, including all of your assets. So your qualified plans, your real estate, any business interest, and your marketable securities and cash. All of that put together, if it was under $11 million, you can avoid federal taxes, but you got to check with your state. You can go on websites and find, just type in your state inheritance tax, and it'll come up pretty quickly. So that was a pretty big number, right? I mean, most people in the United States don't have net worths of over $11 million. And the Trump tax law actually increased that in 2018 to $11 million per person. And right now it's a little bit over $13 million, but give or take for today's conversation. The good news about that is if you don't want to pay federal state taxes, the current law would exempt somebody up to $26 million for a husband and wife. And so one of the big things that we're seeing with a lot of our clients whose net worths have grown because their businesses have expanded, their real estate values have gone up, their stock market and their IRAs have doubled or quadrupled because of the returns in the stock market. Well, they may have not used to have been in a federal estate tax position, but now they might be, because if they got over 10 or $11 million in total net worth, and if this estate tax exemption reverts back to the $5.5 million rule, they might now be sitting on an estate tax problem. And so those are some of the ideas that April's going to expand upon. If you do find yourself, in that position, then you might want to consider some of the advanced planning techniques to either freeze your estate, to maybe consider making some gifts to your heirs. You can certainly make gifts to a charity to reduce your estate from continuing to grow. But keep in mind, there's also some ideas around qualified plans, because what a lot of people forget is that they accumulate a lot of money in their 401ks and their rollover IRAs. But all of that money, if it's not converted into Roths, is subject upon your death to ordinary income taxes. So for some people, if a lot of their assets are in IRAs, it's important to kind of focus on that, because 35 or 40% of it could go away instead of in the form of estate taxes. It might just take the form of income taxes with respect to a decedent. So some of the other laws, I won't go into this net income one. This is for business owners. If you are an S corp or a pass-through entity, there were some benefits to the tax law changes that went into effect. But what I like on this slide here are some of the changes to the RMDs and inherited IRA distributions. So the old RMD distribution schedule used to be 70.5 prior to COVID in 2020. And they bumped up, there's been a lot of changes to the retirement rules, but they bumped up the distribution rules. So you have to take a required minimum distribution now at the age of 72. There was a temporary reprieve during COVID. You didn't have to take any distributions at all. But the big one that we're seeing for a lot of clients is, what are we going to do with our inherited IRA distributions? So most of our clients, their children are listed as the beneficiaries for their IRA. And you used to be able to distribute out that money over the decedent's lifetime. So there was a separate table for the beneficiaries that was calculated based on your age at death and their age, and then the IRS would do a distribution. They did away with that, and now you basically have to take these dollars out over a 10-year period. And for some people, if it's a $2 million IRA, for example, the $200,000 distribution that your children have to take in addition with their income taxes might bump them up into a 39% tax bracket. So it's really important to kind of think about, are there some things you could do with your IRAs that might also factor into some of your charitable giving? And I'll touch upon this a little bit later. But we're seeing a big push with a lot of our clients, not from us, but from our clients, making qualified charitable distributions from their IRAs. And another rule that is on the books, it's actually been on the books every year for the last 7 or 8 years. The IRS could always take it away, but you can make a $100,000 gift directly to a charity out of your IRA, and you can make it to multiple charities. So it's not like you have to just select one charity. And the custodians, like the ones that we work with, Charles Schwab and Fidelity, they're very good. I mean, you can basically just write a list on a Word document, send it to your representative, and they'll basically do all the distributions as long as you provide the addresses of where to send the checks. So there's a lot of opportunities there with IRAs, which I think we'll come back to. But with that, I'm going to go ahead and switch over, April, and let you kind of take over and give us kind of some of the basic and advanced planning from, kind of a legal perspective of the why, clients might want to consider this, and then kind of how do they set these types of documents up.
Yeah, thank you for setting that good background, John. I think it's very helpful for clients in this space to see that everyone needs an estate plan. Why is that? We want to put down our written wishes so that family members understand who we'd like to be a beneficiary, who we wouldn't want to be a beneficiary. And then for this talk, really thinking about being proactive for tax planning purposes. And so first and foremost, having your written wishes down for most states. And if you happen to live in Washington, maybe this doesn't apply to you. Washington has a pretty flexible probate. So sometimes people in Washington can get away with just having a will. But for most states, I happen to sit in California. I practiced in California for 25 years doing planning and litigation. And so happy to work with John and team here at SEIA to help people proactively plan. Most clients in most states want a trust so they can avoid probate process, so they can keep things private and do some of this additional tax planning for the tax landscape that John mentioned. So most people in their basic estate plan are probably going to have a trust and a will, just to make sure that they have listed their wishes for distributions over their lifetime. And then one of the things that came out of COVID, right? Most of what happened during COVID was not good, but there are a few glimmers of hope from that awful time that we all went through, which is highlighting the need for written wishes for things like financial or durable powers of attorney and medical directives. And I know that's near and dear to Compassion and Choice's heart and ours as well, making sure that your written wishes are listed so that if you're alive, been incapacitated, you're in a hospital, you can't have a voice for yourself, you have your written wishes down, not just for tax and other types of planning, but really to minimize the stress, the family dynamics, minimize the risk of going to litigation, and then really just turn up the thought on, hey, how I want to be treated, who I want to be beneficiaries, who I want to be by my side, can be by my side. And so having all of these different documents work together to make a basic estate plan. We would say everyone 18 years and older needs some kind of written estate plan that's listed here. So that's the building block that we think everyone needs. And then, as John so eloquently explained, we might need to be in a place where the basics might cover most clients. And under the current landscape, many clients are exempt from this very high dollar amount exemption from estate tax purposes. But there are some clients, given the current landscape, given the current law that's going to reset in the beginning of 2026, some clients, again, if your net worth is maybe 10 million and above, might be in what we're called a danger zone. And so if your net worth is at that level, then what we say is take your basic estate plan, make sure it's working for your family. Sometimes people set up an estate plan years ago, and maybe they've outgrown their plan because their kids are older or their thoughts have changed. And so building on that basic estate plan, we can take it to the next level for tax planning purposes. What John and I do here at SEIA, and what is fantastic for most clients, is we use a software system called Vanilla to help take the legalese and extract it into charts, actual dollar figures, color-coded systems, so that clients can conceptualize first if their basic estate plan still meets their needs. And then second, if they do need to do something additional, what it would look like, what kind of benefit they could make from doing some of these things, again, that we broadly touch upon, calling it advanced estate plan. But really, it's trying to do something today to allow more to go to heirs, more to go to charity, with just some written wishes. So I'll pause there to see if John wants to interject anything on the basics of estate plan before we jump into the advanced portion of it.
No, the only thing I mentioned, April, at the start of the presentation was, we think it's good. A lot of our clients, when they've set up their wills and their trusts, they may have done it 10, 15 years ago. My biggest recommendation for everybody on the call is, just dust it off, figure out who are the people that are listed on there. A lot of people's intentions change over a decade or 15 years. But, some of the laws may have changed as well. So it's always good to just kind of refresh it. I know when people typically tend to put off trying to talk about this because it's not a pleasant topic. But, the reality is, you want to make sure that your documents are up to date with what the laws are. They're up to date with your wishes and intents. So it really is it's a good refresher to just kind of look and see what you did and make sure if that's still consistent with what you want to do.
Yes. And then I think, what this slide says is, once you know whether or not your basic estate plan is in line with your current wishes, then for those people that might be in a danger zone for estate taxes, and or those people that want to start a gifting program of some level while they're still living, then there's lots of different choices that are available from what we call the advanced estate planning set of tools that the IRS has given us using kind of their rules in the tax code. And as John said in the beginning, it definitely is not one size fits all. Every family is different. Everyone's tax circumstance is different. There's lots of choices. And what we like to do with clients is run through the choices and then really hone in on a few good choices and then run the numbers with them to see what fits. Right? What has a good fit from a heart and legacy standpoint, from a giving standpoint, and then of course, what has a fit to help minimize those taxes. And so here on this wealth transfer planning slide, you see lots of different choices, lots of different irrevocable types of giving. And irrevocable is just a magic word that basically says, if you do one of these types of strategies, again, an advanced wealth transfer strategy, trying to take assets out of your taxable estate and put them somewhere else or give them to other people at some point, it will be stripped away from the IRS considering it being owned by you. And that's the give and take between the irrevocable part. You decide what technique amongst these or others might fit your needs from an estate tax planning standpoint, and giving these assets away in a way that you may have no access to from that day forward, or maybe a little bit of access, or maybe a little bit more access from that day forward. So you are trying to not only strip assets out of your estate, but also take that appreciation from that asset after the day you transferred it to one of these strategies, taking that appreciation out of your estate too. So it's a 2-for-1 transfer. Why are people thinking about doing advanced plans? Just as John said, we're looking at a reset of the estate tax. And a very, very simple example can show you why many people start to think about doing one of these types of strategies or a strategy like this. If a client has just say $20 million, a married couple, $20 million this year and pass away this year, the exemption is so high that if a married couple passed away, both of them this year, there would be no federal estate tax. Their $20 million estate would be completely covered by the 27 million and change exemption level. Imagine though, after the tax sunsets and resets under the current standards, given no congressional change in the next year or two, that same $20 million couple, if they passed away in 2026, so just a couple of years from now, their estate, 20 million, wouldn't be covered by the exemption. And if we think the exemption could grow, appreciate for changes in the economy, just say the exemption 5 or 10 million with appreciation might be say 14 million a couple, they would still have a $6 million taxable estate. And at 40%, they would have to write a check to the federal government of over $2 million. So you can see that, hey, with just that little bit of year change, there is a tax bill. And that tax bill means money going to the federal government and less money going to your beneficiaries. So that's kind of the landscape of where we're at with clients, looking at how can we not write a check to the government needlessly. And so you see lots of different choices here. Spousal Lifetime Access Trust, or SLAT as they're sometimes called, tend to be at the forefront of people's minds these days. It's really akin to using an IRS tax code to give away assets, but allow access to family and spouse, depending on how the trust is drafted. So you can give it away, but still have some moniker of asset reach in for yourself maybe as well. And then some of these other techniques are just a way of providing for you, perhaps a spouse, for generation, For dynasty, which is just a nice trigger word to say keeping wealth within the family line, depending on how long we're allowed to keep it there, maybe 1, 2, 3, or more generations, depending on the state. Having ways where you can build in long-term care, planning around real estate. There's a lot of emphasis on family partnerships, special needs trust, discretionary trust, which is again a fancy name of saying providing for children, not giving them the whole pot of money directly, or maybe grandchildren, but saying, I'd like to put some parameters or some safety nets around distribution for them. And then other types of trusts, like a grantor retained annuity trust, where there are ways, again, that you're able to transfer assets outside of your estate for tax purposes, but still get some benefit, maybe an annuity distribution or so forth. This is not an exhaustive list of options, but some of the high level big ticket items that you might be hearing in the news or on the radio of things you can do, again, to minimize your risk of writing a tax, a check to the taxing authorities with just a little simple planning today versus no plan, or, a wealth transfer plan in the next couple of years. And why are we talking about it in 2024 if the sunset's in 2025? We need time to plan. You don't want to make a hasty decision. And I tell clients here at SEIA, you want to get in line that if you're thinking, yes, I want to do something, I might not know exactly what I want to do, but I want to do something. You want to start having conversations with attorneys now before they get super busy, before you are told, you know what, we're not taking any more clients because we have lots of work. So we want to get the word out to those clients that are interested to do some planning and think about it now rather than pushing it to the last minute. So that's the wealth transfer planning. And I know we have some more things, and maybe John has some more color as well. And it looks like you might still be on mute. We can also just touch upon, as John's just changing the slides there, a little bit about business planning. For those of you that are closely held business or small business owners, there are ways to plan for succession of your business, whether it's internally inside of the actual business documents themselves, or if it's part of your estate plan and wanting to make sure that your trust, your will perhaps, or your business documents really work together to make sure that there is a transfer of your wealth upon death. Many great business clients have this fantastically successful business, but haven't maybe made the connection to make sure that the transfer of that great value, that goodwill, those assets can be either managed by a next generation, by a beneficiary, or, a close up and wind down of that particular business with a liquidation to family or friends or charities. So it's just worth mentioning that if you happen to own a business, want to think about what is your thought on the legacy of that business. Do you want to have documents in place to make sure that your wishes are known? There's also fabulous things, and I know this is John's realm, that you can do in the deferred comp realm and the retirement plan realm to really use the tax code to put away assets for family and for beneficiaries.
April, can you hear me?
Sure can.
Sorry about that, everyone. I guess someone muted me and I was having a hard time finding the mute button. I was just going to add on the advanced personal planning ideas. One of the things that we see as a practitioner working with individual clients that might have these tax problems or might have some interest in doing some of these things, but they get to the edge of the pool and they don't actually execute on it. It's they don't really have the tools or the analytics, the quantitative information that shows them whether or not they can afford to part with a substantial amount of their assets, be it real estate, be it a business interest, retirement plan, distributions, things like that. So I would encourage everybody, right? Leverage the relationships you have with investment advisors. There's all sorts of good online tools. If you're still working, 401k calculators can be an okay resource. We have some very advanced systems, one that's called eMoney, but definitely get a good planning tool that can figure out some of this. We call it gift testing tolerance, right? And it's really designed to figure out like how much of these assets do you really need to keep in your name to make sure that you have enough money to live on, and how much of this is just extra money that might end up paying a bunch of tax. So that's I guess one of the things that we see a lot, April, is individuals just not really feeling comfortable or knowing whether they could give these assets away, so they don't necessarily ever execute on these ideas.
Yes, I think you're so right, because of course, many of these topics can feel very esoteric. There can be so many choices. Sometimes clients don't really know where to start. I know when I've sat in client meetings here at SEIA, it's so powerful to see the different choices available and then seeing the number game, not only how much is saved in taxes, but on the flip side, how much is able to go to heirs, how much more might be able to go to heirs by doing 1 or 2 or 3, maybe easy to more complicated gifting strategies. And I know that part of the conversation when we're talking about gifting is certainly charitable planning. I know that charitable planning for many clients is always part of their estate plan. They might have lifetime charitable gifts that they're making on an annual basis. And sometimes clients aren't sure if they want to leave a charitable gift, right? So there's the wide gamut of things that people can think about when it comes to charity. But I think one of the best things to think about with the charitable giving, again, you can see on the screen, lots of different options for giving, whether it's during your life and you can see the good dollars put to work, or if it's part of something from a testamentary standpoint from planning, where you can see, hey, I have my legacy, I can not only save in taxes, but do some good, help my family see my particular wishes, help a good cause, maybe give back to a cause that helped our family. And so there's lots of different reasons other than tax to consider charitable planning. And so you see the list here of the different kinds of charitable plans. Some can provide an income tax benefit to you during life when you set it up. Sometimes it is pure estate tax benefit. Sometimes there's a beautiful blend between the two. There are ways to give to a charity where there's annuity coming back to the family during life. There can be, a ways where the flip is concerned, and you can see the opposite where a charity can get an upfront gift and then family members can get a remainder gift. And so there's lots of different options that can suit your needs. I know that a lot of clients, when they're not even sure if they're charitably inclined, if they see other options and they're not really, going with one option or the other, they definitely, most of the time, want to rather give to a charity than write a check to the IRS, right? So that's a bottom line, last ditch effort for some tax planning. And it's certainly good, right? Doing some good, doing some other types of legacy planning. As I've said, I know that John, you were going to touch upon the QCD, so I'll let you interject there because I know that's something that you're seeing lately.
Sure. Yeah, we've seen a huge uptick in the clients making multiple distributions through their current IRAs that they have. So you can use up to $100,000 on an annual basis and give directly to multiple charities through your custodian. So most custodians should process those requests for you, but you have to give it directly from the IRA. So that's definitely something that you might want to consider doing. We've also seen a big uptick in donor advised funds. And I mentioned earlier, we partner with Charles Schwab and Fidelity, which represent like 75% of the independent community market. And both of those institutions have their own donor advised funds. So think of these like your own, it's like a poor man's foundation. So it's very simple. You can basically just transfer appreciated stock into your own donor advised fund. You can leave that stock in there if you want. And then effectively you can give away 5% of of that corpus on an annual basis to whatever charities that you want. But you can actually get some income tax deductions for those types of contributions. So the financial industry really tried to design these as a way to encourage more charitable giving. But most people feel like, well, I don't have that much money where I would establish a private foundation, and it is relatively there is some cost involved to establish one, to do the tax returns for a private foundation. So these donor advised funds are a really easy way for you to just kind of establish your own mini foundation within these organizations. And then you or your heirs or your family can basically give this money away to charity down the road, but you personally will get the income tax deductions in the here and now. And so I heard what April said, right? A lot of clients might be doing this, just because they feel, attached to the organization. But, let's be honest, the tax deductions are also helpful and nice. And as long as they are still there, I think it's, if you're going to give the money to charity anyways, sometimes it might make better sense to give it over your life so that you're actually recognizing some income tax deductions, as opposed to, a lot of clients we see, they just might leave a portion of their estate to charities, and that's fine too. But there are some income tax savings that you could realize over the course of your life by doing things like that. So only other thing I didn't put on here, there are, again, I mentioned that IRA. It's kind of like a tax time bomb, because somebody owes that 35 or 40% in income taxes and state income taxes on that asset. And if you've got $1 million or $2 million in an IRA, those are also good assets to think about leaving to charity, because if you're not going to use all of them over your life, any portion of that goes directly to a charity effectively is not going to pay any income taxes on. So you could give more to a charity. But, to April's comments earlier, you might want to think about, if you gave a large portion of your assets to a charity or non-family, are there other ways that you could replace some of that wealth, maybe using some sort of charitable remainder annuity, or maybe an irrevocable trust that's funded with life insurance? So there are a number of different ideas that you can, kind of look in the charitable world. But I think it also goes back to that comment I made earlier, right? You kind of want to make sure you're taking care of your own needs first, for what you and or your spouse may need for your own retirement and living expenses, as well as healthcare. And then once you figure that out, then you can start thinking about, well, are there some individual giving strategies that I could do for my kids or grandkids? Are there some additional giving strategies that I could do for some of the charities that are important to our family? So I think those were the last comments that I had. April, before we wrap up, was there anything that you wanted to add as well?
No, I think you summarized it very well. I think the bottom line we want to say is the tax landscape is about to change. I think it's good to have a circle of collaboration, right? We work with Compassionate Choices. We work here at SEIA. We try to wrap around whatever the client might need just to navigate this very complex tax landscape in a way that is not only promoting your particular legacy, minimizing tax, but then making sure that upon passing, we keep the stress level and the tax dollars as low as possible. So I think, that's the big takeaway for clients is there's a lot happening out there, but there's also a lot you can do if you're armed with just a little bit of information. So hopefully you found that helpful.
John, I just want to just say from a really huge thank you to you and April, because what we say at Compassionate Choices, as you know, we're about end-of-life planning, and financial and estate planning is part of your end-of-life plan. And it is so critical, and there's so many things that you've raised to suggest the questions that will lead to answers. And as we go into 2025, it is clearly a tsunami of looking at planning and looking at the tax laws and getting ahead of it, which is our mantra. If anyone wants to, we have a few more minutes to put any questions in the Q&A. We'll put that up to John. And I don't know if you and April just want to take a couple of minutes, John, and not to put you on the spot, but maybe just give some perspective on the market and where you think the economy's going, and just very general. But I just thought that I'm going to take every moment I can with you and April to get your insights and perspectives.
Sure. Yeah, I try to leave those slides out of the deck, but happy to just share a couple of thoughts. I mentioned earlier, right, the stock market was up 26%. Our memories tend to be really short on these things because everybody forgets that in 2022, the stock market was down 18%. And it was kind of a tale of two cities, if you will. You had last year a great stock market, but it really was narrowly driven by 7 tech stocks. So large growth was up almost 38%, large growth index I'm referring to. But in 2022, the tech stocks that led the rally last year, they were also down about 30%. So I will say, some of what we see, Sam, a lot with charitable planning, kind of tying that in, or estate planning, a lot of the clients that have seen this boom and bust cycle, they own really large positions of Apple, Microsoft, Google, Amazon. In fact, in working with Compassion and Choices, those are a lot of the stocks that we see that are donated to the organization, because it's just kind of one of these like, wow, it went up a ton. Like, I don't really need all that. Why don't I just, do away with it? But keep in mind that which goes up that much can also go back down. So there are, a lot of concerns, not only with clients, but economists that, how much longer can this economic cycle run? I think the odds-on favorite are that we likely get into some trouble in the second half of this year. Right now, the labor data looked really good in the first quarter of this year. And the Federal Reserve was anticipating that they were going to have to reduce interest rates. And so one of the kind of the boxes that they've painted themselves into, kind of like they did with transitory, the concerns about inflation being transitory. So they never raised interest rates until last year. But now they're talking about, well, they said they were going to reduce interest rates 3 times. And it doesn't look like they're going to do that. So if they don't do that, will we see the stock market slide back a little bit? But it really comes down to jobs at this point, right? The labor market is keeping the stock market, on high. So if you're really looking for something as an indicator as to where the economy is going to go, I think it was the first President Bush, right? It's the economy, right, and jobs, and so ultimately, at the end of the day, we have an election coming up this year. It's likely going to be really messy. Living inside the Beltway, I kind of just mute my television on the weekends. But, the reality is you've got inflation, interest rates from the Fed, a very strong job economy, an election cycle coming up. We got a lot of things going on, and there's some geopolitical stuff going on as well. And at some point, we're going to get into a recessionary environment. So, I likely think that it's likely coming inside of the next 12 months. But it's possible that we could continue to limp on for maybe another, 18 to 24 months. But, that shouldn't drive your planning. So we always try and tell clients, right, you really want to have a portfolio or a plan that should be all weather. It should do right by you when the market's doing extremely well. But it should also be positioned in a way that you can still do all the things that you want to do, be it estate planning or charitable planning or just, regular traveling and gifts to kids and grandkids. You should be able to do all those things in good and bad markets. So I don't want to be the bearer of bad news, but it does seem like we've had a really good run. And, sooner than later, we are likely to see a recession. And I kind of view that it's likely going to be sooner, Sam. But I'd happy to be wrong about that, though, too.
Trouble finding the mute button as well. As we bring this, I just want to let everyone know that we have recorded this. We had some people that had conflicts, but we are going to send it out to everyone who RSVP'd and make it available. And as John mentioned before, you're welcome to reach out to John and April directly, or connect with me to just connect you to them. But I just urge you to ask the questions that lead to answers. John, and I just met April, but it's been wonderful, has just been really just supportive in finding the right solution and alternatives And he's one of the smartest people in the rooms I'm always in. So, like I said, please, he's doing this to support our supporters and to find a win-win for your estate and financial planning, and to possibly help Compassionate Choices with a question mark. I'm going to say thank you again. And John and April, I will leave the last word to you, and we'll sign off from there. And have a wonderful day, everyone.
Sure. Thanks, Sam. Appreciate it. Appreciate everyone's attention. And as Sam mentioned, if you have any questions about anything that April or I spoke about, if you want to just have a general conversation about your current plan to see if it's up to speed with what you're looking to accomplish, we're happy to have that conversation. And feel free, if Sam will probably pass around our contact info. You're more than welcome to reach out to us directly, or you can contact Sam and he'll know where to find us.
Once again, thank you again, and I look forward to continuing our conversation. And I'm just going to put it out there now. John and April, I'd love to do part 2 of this and build on what we've done and get some more of your great perspectives. With that, I'll say goodbye and thank you for joining, and thank you for presenting to us.
Thank you. Bye-bye.
Bye.